Chapter 8, how to pay no tax on dividends and capital gains. Oh, man, this is going to get fun again. I love it. If you're married filing jointly with taxable income of $77,400 or less, you are in the 12% bracket. However, add $1 more and now you are in the 22% tax bracket. See how that works? $77,400 equals 12%. $77,401 equals 22%. That's how marginal rates work. The more income you receive, the higher the tax rate on that additional income will be. The tax you paid on your previous income doesn't change, though. You only pay higher taxes on the amount that puts you in the next highest bracket. Now, let's say you have total income of $70,000, which consists of $60,000 of work income and $10,000 in the form of qualified dividends and long-term capital gains. But you need $80,000 to maintain your lifestyle. So you do take a $10,000 distribution from your IRA. So now you have $10,000 from IRAs, $10,000 from qualified dividends and long-term capital gains, and $60,000 from working. That will put you in the 22% tax bracket, the IRA distribution will. The following April, you go visit your tax guy to fill out your taxes, and he gives you a pleasant surprise. He says, hey, you only have to pay 15% on the $10,000 of qualified dividends and capital gains, even though you are in the 22% tax bracket. That's good news, right? Unfortunately, the reason you are in the 22% tax bracket to begin with is the IRA distribution put you there. Now you owe over $3,000 in taxes. Again, going back to one of the previous chapters, IRA distributions affect a lot of other things, my friends, and qualified dividends and capital gains do as well. Now, you wise up and use a different strategy for the following year. You still need $80,000 to get by, and you're still only making $70,000 from work and then qualified dividends and capital gains. To make up the difference this year, though, you take a distribution from your Roth IRA, not your traditional. Now, when you go back to your tax guy, you really do get a pleasant surprise. You pay $3,000 less in taxes. And you say, whoa, how can this be? Your tax guy explains. Your IRA distribution last year not only increased your marginal tax rate to 22%, but it also made your dividends and capital gains taxable as well. That $10,000 IRA distribution cost you $1,500 in income tax plus $1,500 in taxes on your dividends and your capital gains. A double whammy if ever there was one. Because your Roth distribution is tax-free, you remain in the 12% bracket. Taxpayers who are in the 10 to 12% bracket do not pay tax on qualified dividends or capital gains. So not only do you not pay tax on your Roth, you don't pay tax on your other investment income as well. Isn't the Roth beautiful? Remember, taxpayers in the 10% or 12% bracket pay nothing on qualified dividends or long-term capital gains. Now, many people believe they're saving on taxes with their IRA because they're deferring the tax until later. This is true for some taxpayers. I'm not going to deny that, especially for those currently in a high tax bracket. In that case, deferring a high tax now until later when they may be in a lower tax bracket is actually pretty smart planning. But what about taxpayers, the vast majority of them who are in the 10, 12, and 22% brackets? Are they actually saving taxes by deferring? I don't think so. Some analysis will, of course, we need to go into your specific situation, but don't simply fall for the fallacy that deferring income saves taxes. It most certainly may not. In fact, as the example above shows and many previous ones in the other chapters, it could actually lead you to pay more in tax, maybe even a lot more. To close this chapter, please remember you want to reduce ordinary income tax investments like bonds and traditional IRAs. And you want to increase your tax favorable investments, obviously Roth IRAs, even qualified dividends and long-term capital gains are considered tax favorable. If you can get your income from Social Security, Roth IRAs, and qualified dividends and long-term capital gains, you are going to be in a very good place from a tax perspective.